What if I told you all of your beliefs around money were wrong? As a financial advisor, I'm going to address the biggest myth in personal finance, whether taxes matter, and give you 3 easy steps to avoid the consequences of this myth. Imagine walking through a store and buying everything that's on sale. You walk out with a pair of kid socks, a book that's in a second language, and a can of beans. You bought these not because you needed them, but because they were on sale. In fact, you have no use for kid socks, you don't even speak a second language, nor have the desire to learn it, and you're allergic to beans. In this case, focusing on the sale led to irrational decisions. Likewise, when you focus on this myth, you will make irrational money decisions. This is why you're bad at making financial decisions, and I'm going to show you how to make smarter decisions. While you don't go to the store and make the obvious decision of buying things that are on sale, the way you make this mistake is a little more subtle. Let me show you. Have you ever had a question that you've taken to Google? I think we all have at one point or another. And while we're well-intentioned in learning more about our finances, there are 3 letters that skew our thinking and send us off in the wrong direction. This is often the top search result for Google, so it's so much easier to make this mistake. And this is where the problem exists. Most of my clients are in tech, so I'll just use a tech employee for example. Most tech employees are given what's called an RSU, which is kind of like a form of stock. Once they're given RSUs, they're going to go to Google and search what an RSU is, and then next they're going to look at the tax consequence. Psychologically, once we start to learn about taxes, we dangerously start to frame all of our thinking to optimize for taxes. And this is often the worst place to start. In fact, there are 3 things that are more important than taxes that we need to address before we get to the 3-letter word. There's a 3-step process that I guide my clients through to help them make better money decisions. The awesome thing about this framework is that it often allows you to come to conclusions without having to understand the complexities of tax or even investments. So let's dive into step 1. I'm certain 99% of you haven't done this, yet it's the most important place to start when making money decisions. There's a Harvard graduate named George Kinder who realized a disconnect between what people value and how they actually spend their money. What he did is he put together 3 questions that help align people and their lives and what they value with how they actually spend their money. These questions may seem a little bit odd, and you may consider asking your spouse or your partner these questions, but here's question number 1. Imagine you have enough money both now and in the future to satisfy all of your needs. Your mortgage is covered, your food expenses are covered, your transportation is covered, you have all of that covered. Would you change your life? If so, how? Essentially, this question takes money out of the equation and really gets you to think deeply about what it is that you would love to do. So be creative with the answer here. Question number 2. You're back in your current financial situation and your doctor gives you some bad news. He says that you have about 5 to 10 years left to live, but you'll feel completely fine up until the end. You'll continue in your current health. Would you change your life? And if so, how? This question also gets you to think deeply about what's most important to you, but it puts an added spin or an added twist to it to give you some limitations, creating a little bit of pressure. The last question goes even deeper, but I'll save that one for my clients that I ask in addition to a bunch of other questions that really bring your values and your goals to the surface. Not asking yourself these questions is about as bad as buying a book in a second language that you don't speak, and you don't even have any goals to learn a second language. We need to align your money with what's most important to you. In this case, the sale should be a secondary consideration to your values and goals. Likewise, tax should be a secondary consideration to your values and goals as well. Now that we've gone through step 1, which is addressing your values and goals, we need to move on to the next most important thing, which if you don't do, it's just as bad as buying beans when you're allergic to them. So let's go ahead and look at step 2, or the second most important consideration when making money decisions. Imagine investing all of your money into a new cryptocurrency called Bad Bean Coin. You probably wouldn't do it for a couple of reasons. Mainly, you'd be worried sick about how it's performing, you'd be watching it in a cold sweat, it'd be keeping you up in the middle of the night, you'd be pacing the room, just watching the stock price. This is known as risk tolerance. This has everything to do with your emotional willingness to take on risk. We need to know if you have an emotional allergic reaction to Bad Bean Coin. You also probably wouldn't invest in Bad Bean Coin because you can't afford to lose everything in a single investment. This is known as risk capacity. Risk capacity is more about numbers and has less to deal with your willingness, but more to deal with your financial ability to take on this risk. For example, Elon Musk can afford to lose $10 million on Bad Bean Coin. You, on the other hand, cannot afford to lose $10 million on Bad Bean Coin. While you're not silly enough to be putting all of your money into bad bean coin, this is where I see people making a mistake that's just as bad. I see this most frequently when people have a large portion of their net worth tied up into a single stock, which is very easy to do when you are granted RSUs. And people hold on to this stock, taking on financial and emotional risk, all based on a faulty tax belief. They have a terrible allergic reaction, but it doesn't matter to them because all that matters is that they're getting it on sale. Over-concentrating your net worth in a single stock often brings financial and emotional consequences that you can't afford. You do so in the name of taxes that you don't even understand in the first place. This is why a 50% tax rate doesn't scare me as bad as taking on risk that you can't afford. You tell me which one is worse, 50% tax or losing 50% of your net worth in a single day. And that's why risk tolerance and capacity is more important than taxes. If you're finding value in this information, please hit the like button down below. Are you starting to see how taxes isn't the most important thing to focus on? I'm not kidding when I say that focusing on taxes can bring financial ruin and cause you to fail in your goals. Here's the next most important thing that you should be focusing on before we get to taxes. First few things that we've looked at, values and goals, risk tolerance and risk capacity, have all been very emotionally touchy-feely aspects that we need to consider. The next one is going to be much more tangible, and this is where most people start their decision-making process when making money decisions. While getting my undergraduate degree, I had a financial planning professor that would say the most important wealth building tool that you have is your income. It's your income and your asset appreciation that's actually going to make the biggest impact in building your wealth. There's a lot of people that think that there's some secret or some tax loophole that they're unaware of that's separating them from building wealth. If only you just understood the tax code a little bit better, you'd be much better off. Or as Dave Ramsey put, and only he can say it as good as this, that there's some double backflip family limited partnership trust that's the secret to building wealth. The biggest thing separating you from your financial goals and your dreams of building wealth isn't some tax write-off or some secret loophole, but rather it's most likely going to be a combination of your income and your savings rate. But our society has an obsession with complexity and glorifying tax savviness, despite it not actually being the actual driver of wealth. Some people love to come off as sophisticated or smart or savvy, and one way that they've conveyed that facade has been through talking about exotic taxes. While it may garnish attention on social media or online chat rooms, this allure is actually taking your focus off the third most important thing, which is assessing the financial merit to your money decision. Is this stock in or out of the money? Is this fairly priced? Is it underpriced? Is it overvalued? What's the expected return? And what are the financial repercussions of this decision? Of course, there's going to be a few one-off cases where some tax loophole was actually a big factor in creating wealth, but for the rest of society, it's just not that way. This reminds me of a political cartoon that I once saw with two doors, and the first door had a sign above it that said complex but wrong, and there was a bunch of people standing in line. The second door had a sign above it that said right but simple, and there was only a few people standing in line. Tax complexity sells, and sometimes justifiably so, but we just need to ensure that it's in the right order of priorities. Let me show you. There are a few types of common taxes. One is going to be the income tax, second is capital gains tax, and the other is going to be estate tax. All of these three are based on an assumption that you either have one, income, or two, appreciating assets. And thinking that tax is the driving force in creating income or creating an appreciating asset is quite literally putting the cart before the horse. Most often you're going to need income or appreciating assets in order for tax planning to actually have a large enough impact. All this being said, it's just to emphasize the point that it's going to be your income that's going to be the driving force of your wealth. But whether it's honest curiosity or the allure for tax complexity, you're going to have to face taxes sooner or later. So let me help you view taxes in a much healthier way. If you'd like to work together in taking a holistic approach to your money, more information in the description below. The truth is, taxes do matter, just not as much as you may think. Let me show you an example. Have you ever heard anyone say, let me buy that car because I can write it off? Or it's a tax deduction, or I can claim this as an expense. If somebody's saying that, you better hope that they understand the 3 steps that we just took in order to get to this point. Otherwise, they're making just as silly as a mistake as walking into a store and buying whatever it is solely because it's on sale. You know how credit cards sometimes give the reward of cash back? So if you spend $1, they'll give you 2% back. So you get 2 cents for every dollar that you spend. Well, taxes is kind of like cash back, but instead of it being a percentage of the amount that you spend, taxes is based on a percentage of what you earn. So if I offered you the deal of giving you 2 pennies if you give me $1, that wouldn't make financial sense, right? Because you would ultimately end up having had lost 98 cents. You wouldn't spend that dollar to lose 98 cents. So if you're optimizing for a percentage of either the amount that you spend or, in the case of taxes, of what you earn, then you're physically stepping over dollars to pick up pennies. And that's another reason why making decisions solely based off taxes is just as silly. The money decision that you're making needs to align with your values and goals, your risk tolerance and risk capacity, and have financial merit to it before we even consider taxes. This is why I say that the framework can often help you make financial decisions without having to understand complex financial terminology or even taxes. The fact is, taxes do matter. Only after you've gone through the first 3 steps. Saving taxes shouldn't be your objective, it should be the cherry on top of your objective. I personally like to view tax write-offs or deductions as a discount. I don't go to the store just to get a discount, I go to the store to get whatever it is that I need, and then the discount on top of that is just an added bonus. Roughly speaking, the discount is equivalent to whatever tax bracket you're in. So if you're in a higher tax bracket, then there's more financial incentive to get that discount, whereas if you're in a lower tax bracket, the discount is a little less sweet. Honestly, there needs to be a balance between all of these considerations, but the more holistic approach that you take, the better off that you're going to be. And of course, there's going to be one-off exceptions and anomalies to these rules, and that's why I highly suggest working with a professional and not relying solely upon this video. So the next time that you're in a store looking for something, just know that a sale isn't bad, just know that it's not as high of a priority as making a decision based on what you actually need and if it has financial merit. This may come as a surprise to you, but there are no tax benefits that are exclusive to RSUs. So let me help you make a better decision around your RSUs by watching this video right here.